Hello and welcome to today's webinar on career insights on commercial banking in India. This webinar is hosted by the CFA Institute and CFA Society India. My name is Rajiv Radhakrishnan. I currently work as a Chief Investment Officer at SBI Funds Management. I am also a director on the CFA Society India board, and I have been involved with the career services initiative conducted by the society. So my experience spans about more than 23 years in the asset management industry. I initially started my career with UTI Asset Management in the equity research team, and subsequently moved over to managing fixed income funds for about 7 years with UTI. And I've been with SBI Funds Management since 2008. Before I introduce the speaker for our webinar today, I would just want to go through a few couple of housekeeping notes on this particular session. The session would be for about 60 minutes. That includes 15 minutes of Q&A after Mr. Hemant's presentation. What we shall be doing is we shall leave adequate space for Q&A. What you can do during the session is that please feel free to submit your questions in the query box at the bottom of the panel. And the webinar would subsequently be available for view after the presentation concludes. And we also would request you to share your feedbacks on the session in the evaluation survey. Let me now introduce our speaker for the day, Mr. Hemant Adhikari, who is Assistant General Manager with State Bank of India. He's got more than 23 years of experience with the State Bank Group, which spans multiple verticals, starting with Treasury, the Global Markets Division, Trade Finance, Credit, as well as spending a few years with SBI DFHI, which is the first primary dealer in India. Mr. Hemant Adhikari is a charter holder of the CFA Institute. Apart from being a certified risk professional from the GARP, as well as holding a postgraduate degree in management science. So I shall now hand over the floor to Mr. Hemant Adhikari, who shall go through the presentation. Thank you.
Thank you, Rajiv, for such a nice introduction. Hello, everyone. Today, my presentation is about career insights in commercial banking. Commercial banking, how you, through the knowledge of CFA curriculum, how you will be able to manage well in the commercial banks. So the presentation starts. Basically, commercial banking is done by three main participants, three main institutions: public sector banks, private sector banks, and the foreign banks. So private sector banks, when we talk about, there are large private sector banks like ICICI Bank, SDFC banks, Kotak Mahindra Bank, and small finance banks also now started coming in. And there are very few payment banks and the foreign banks. So the main commercial banking is dominated by the public sector banks. If you see, around 65 to 70% of the market share is with the public sector banks. So we will be seeing how the public sector banks, they do the recruitment, and how the recruitment is done by the private sector banks and the foreign banks. So public sector banks, basically, they have a standard format where they will be having MCQ, multiple choice question exams, in which they will test your quantitative aptitude, analytical reasoning aptitude, English, and knowledge about the current affairs. So with this, a plain graduate, a person without any professional degree, just a plain graduate, can write this exam. And some of the banks have the pre and main. Few have only one exam. After this exam, there will be group discussion and interview. So the unique feature of this is, for this, you don't have to do any professional degree like MBA. You don't have to be an engineer, just a plain graduate with a graduation with, I think, some basic requirement of 55-60% of marks. You are eligible to write this exam. So with this exam, you are you are getting an entry into a public sector bank, and then you are exposed to commercial banking. So then the private sector and the foreign banks, they have, which we all know, they have a direct recruitment either through campus interview or one-to-one basis interview. So that way, the private sector and the foreign banks, they recruit people. So now when I am talking about the public sector banks, because in India, on an average, every year, around 25 to 30,000 of vacancy they create, and they recruit these plain graduates. These plain graduates they recruit, and the structure is there are four ways one person can enter these public sector bank. One is as an associate, which we can call as a clerk in a bank. So the pay structure would be around 5 lakh to 7 lakh when you are joining. And the second one is the when you are joining as an officer directly into the bank, that is the called probationary officer in a bank. So the salary structure would be around 10 lakh to 12 lakhs when you are joining, which is CTC, 10 to 12 lakhs. And there is one more thing, which is the senior manager. Senior manager, where a chief manager and the assistant general manager come, there the salary structure would be around 20 to 30 lakhs. And then there is a top executive. Top executive means we recruit chief investment officers like Rajiv. We recruit chief information officer. We recruit chief risk officer. These are the people executive which we recruit directly, where the package is high and these packages are negotiable. So now, what strategy I am suggesting here, if someone, because of his background, or because of something, if he or she is not able to pursue MBA from a very this big management institutes, or engineering from big engineering institutes, and they will find it difficult to get placed in any of the commercial institute, any of the financial institute. But in the banks, by writing this exam, just by doing a plain graduation with nominal 55 to 60% mark, you get an entry. When you get an entry, after getting an entry, you are exposed to various departments of the commercial banks, and you have a career path. Which career path I will discuss in the next slide, which starts from the assistant manager. Generally, the categorization is like this: assistant manager, deputy manager, manager, chief manager, assistant general manager. Likewise, it goes up to chairman. In our bank, the highest level of post is chairman. So just by doing a plain graduation, you get an entry and you get an exposure. So if somebody who is joining the bank, and along with the bank, he or she is pursuing CFA program. During the CFA program, the person will be equipped, and side by side, the person is gaining experience in the commercial bank. So though the growth part may not be that fast, and in terms of salary packages, it may not be that fast, but after gaining an experience of 5-6 years, and during that time, if someone is able to finish the CFA, is able to get the CFA charter, then the value addition would be very good, and they will be able to place themselves in a very, very good position in the commercial banking industry. Or even they can find themselves placed in the investment banking and other banking in the other industry like mutual fund and insurance. So basic thing is, first you need to get an entry. Along with that, you pursue your CFA curriculum, and then you will be able to place yourself without having any degree from any prominent colleges. So this is something which I wanted to mention here. Now, this MCQ test and these in the MCQ test, our CFA curriculum may not help you much, because this MCQ test would be based on your quantitative aptitude, how quickly you are able to solve mathematical problems, and your reasoning and analytical ability, how you are able to apply the reasoning and able to solve the problem. But in the interview and the GD, if you are going through the CFA curriculum, you are a candidate in the CFA program, then you will get some knowledge which is relevant to our commercial banking. There, this knowledge will definitely help you to get through in the interview as well as in the group discussion. Then, if someone is pursuing CFA program, then after getting selected in the bank, there is a possibility that with your CFA program, you will be able to place in very good department, cream department. We call those department cream department, like investment banking, treasury, even foreign postings. Or subsidiaries like SBI Mutual Fund, SBI Cards, SBI DFHI. Like in our bank, I am telling like that there are subsidiaries in other banks also, and other banks also have the branches abroad. So if you have done your CFA charter, if you are pursuing CFA program, it provides you a very good opportunity so that you will be able to post it abroad and get that experience. With that experience, you can come back and you can continue in the same bank, or you can try with the other bank. So this was all about how to enter a commercial bank, mainly the public sector banks in India. So now I will be talking about what are the main and important departments in the commercial bank, and how our CFA curriculum helps us to equip ourselves to be fit in those departments. Basically, there are many departments, but I'll be talking few 4 or 5 departments which are very, very important and critical for a commercial bank, and CFA Institute, how it is helping you, that I am discussing in the subsequent slides. Yes, now I am talking about 4 main departments are credit management department, treasury management, risk management, and the now wealth management is also acquiring a very important and prominent place in the commercial bank. Other department we can see many of the commercial bank, they have their mutual fund subsidiaries, they have their credit card division, they have their insurance, and some are having primary dealership. So this all important departments we will be discussing one by one in the subsequent slides. The first and the most important department in any commercial bank is the credit management department. Credit management is giving credit, giving loans. So giving credit, giving loans is almost 70% of a bank's portfolio. Our out of 100, my 70% is invested in the credit, in the loans, in the advances. So it is such an important department which covers a majority of my portfolio. So this needs lot of skills, lot of analysis is required, for which our CFA curriculum helps broadly and vastly. It is covered in our CFA curriculum. Now we see what are the things we do in a credit management. Credit management means I am giving loan to somebody. I can give loan to somebody, and how I can give loan and what are the things I have to do when I am giving any credit to anyone. First thing, what we do a credit risk assessment. What is credit risk assessment? Credit risk assessment means what risk is involved, whether the person whom I am giving funds, not my fund, these are the funds of the public, because we commercial banks, we are a financial intermediary. We take funds from the depositors, and that funds in lend it to the people, those who need these funds. So now my responsibility towards my depositors is that I need to invest that fund. I need to give loans or credit to those who are capable of repaying it, those who are having capacity to generate sufficient cash flows, so that with that cash flow they are capable of repaying the loans. So in this risk assessment, we use various tools which have been extensively discussed in our CFA curriculum, which in the subsequent slide I will be discussing. So with those tools, we do a credit risk. Means what risk is involved. Higher the risk, higher would be the risk premium. Lower the risk, lower would be the risk premium, and the lower would be the interest rate charged. Because it's a credit product, we charge interest, and interest is our income. So now, after assessing the risk, after assessing what credit risk premium would be applied, it will be it will go for the credit approval process. Once the risk is assessed, what are the risk involved in one particular credit, then it goes for a credit approval. Credit approval process is again, they will see what risk is involved, what credit premium to be applied, and what should be the final pricing of that product. With that pricing only, that credit would be approved. So this is the credit approval process. In our bank, no, all the banks, in all the commercial bank, credit approvals happens in based on limits, discretionary powers, sanctioning powers. based on the hierarchy. For example, one officer of the chief manager rank, if he is able to sanction 1 crore worth of loan, AGM, Assistant General Manager, can sanction a loan up to 2 crores. And afterwards, there are committees. So this credit approval happens based on the product and based on the amount of the credit. So this credit approval process works in this way. Then once the credit is done, once the loan is sanctioned, then it requires periodic regular monitoring. In that regular monitoring, what we see that whether the repayments are coming properly, whether the client is making payment as promised. And sometime in the credit, when we sanction credit, we give some stipulation to the client that these are the stipulation he has to fulfill, like he has to cover insurance, he has to submit stock statement, the client has to do this certain things, certain condition we outline. And if during the process, the credit monitoring process, if we find the client is not fulfilling those conditions, we may ask client either to repay the entire loan, or we may change the price. So this comes under credit monitoring and the credit control. Then the next important thing is credit portfolio management. In a bank, we have various credit portfolio. Credit portfolio means we have auto loans, we have agri loans, we have personal loans, we have home loan, we have commercial loans. So we have a portfolio, we have bucket of various loans, which we give to different industries, different segments, different even in the personal segment. If you see, we have discussed personal loan, car loan, home loan. Now in the credit portfolio management, what we do, we see if there is any risk. If we see one particular industry, it is having more risk coming forward, or that particular industry, our controller, our regulator feel that that is going to be riskier now. So we try to reduce the risk, and those industry which we feel are going to grow from here, then those industries, those segments, we try to increase our credit exposure. So this is called credit portfolio management. And then ultimately, when we have given loan, there are certain people who do not pay. We know there are many people who have not repaid and gone abroad. We are still trying to get them and recover our amount. So this credit loss is an inevitable things. When we give loan, there is a possibility that there would be some credit risk involved, and there is a possibility that we may lose some such loan. Some could be because of some inevitable reasons, because of some losses which happens to the client, and he or she is not able to repay the loan. So those loans, we need to do some credit loss provisioning. The provisioning happens on the type of loss we feel. Sometimes there are various categorization in this segment. We will say substandard, doubtful, then the loss. Based on the category, we do the provisioning so that we have sufficient funds available, sufficient provisioning done, so that ultimately, if we lose that, if we don't get anything out of it, even then we should have some provision. So this is all about our credit risk management. And credit risk management, as I previously told, it is the most important department in any commercial bank, because around 70% of our investment or our asset class comes from this sector. Then we will discuss here how CFA curriculum is helping us in the credit risk management, and how a person will be equipped to find himself fit in the credit management department. We study economic and industry analysis through business cycle. We study the business cycles, in which stage of a business cycle that particular industry is there. We study, like, there is a peak, there is a recovery, there is a slowdown, there are various business cycle. So this business cycle analysis helps us to do the fourth one, credit portfolio management. If we know that one particular industry is at the peak, and there is a possibility from there it will face a slowdown. So as a credit portfolio management, we will try to reduce our exposure in that particular industry, and will try to get more exposure in those industries where we are feeling that this segment is going to grow from here now. Yes, after COVID, just a practical example I want to give here. Just after COVID, we saw that there was a word coming as a K-shaped recovery. We were seeing that one portion of our economy was growing, like the urban economy was growing, and the rural economy was not growing. So if we are able to understand, yes, this phase, this urban economy is going to improve and going up, so we will try to reduce our exposure in the rural economy and try to put our exposure in the urban economy. So like now the rural economy has also started improving. That we are seeing that also started recovering. So we will try to again rebalance, and we will start giving rural loans. We will start taking exposure in the rural economy. So this is all about how we are using the business cycle analysis, what we study in our CFA curriculum, to do the credit portfolio management. Now, the first thing which I told about the credit risk assessment and approval. For that, we need to understand the financial statement. So financial statement, income statement, balance sheet, cash flow, and the various other ratios which we study. In the CFA curriculum provides us a very good idea about how to study an income statement, how to study a balance statement, what is cash flow, and based on cash flow, how we can do a funding. If we know a particular industry is going to have this kind of cash flow, so based on that, we can decide the repayment schedule for that particular industry. Now, during that study, we also study various ratios like current ratio, debt equity ratio, interest coverage ratio. Just one ratio I'll talk here. Current ratio. This is a very, very basic ratio. Current ratio is a ratio of your current assets and current liability. It is current assets divided by current liability. So what it is, if your current assets are more than your current liability. Current liabilities means those liabilities which you have to pay within next 12 months. Current assets are those assets which will be converted into cash in next 12 months. So current assets and current liability. If you have more current assets to pay your current liabilities, so you will be treated as a sound entity. So this is one analysis. Like that, we studied various analysis in our financial analysis, where with the help of various ratios, we decide the soundness of that particular industry or an individual, and the pricing also we do. And we, as we study P&L, profit and loss account, balance sheet account, this helps us to get a proper knowledge about the credit risk exposure. Our curriculum has broadly covered almost all aspects of the credit risk analysis, and how we can do a pricing. Various ratios are also covered in details. So now I go to my next department, which is the Treasury Management department. I told 70% of around 70% of our commercial banks assets are in the credit, but in the treasury also around 25 to 30% our treasury manages. Sometimes these investments are out of regulatory requirement. Sometimes these investments are because we want to have a higher yield. So in this, our treasury has basically two main functions. One is that they do the trading in various market, like fixed income market, equity market, forex market, derivatives. So this, in the trading, we do these activities, and there is one more activity called investment activity. Investment activity where the time horizon is slightly higher, and we take a long-term view of that asset class, and based on that long-term view, we do the investment. And trading is a very short term. And to control these two things, these two activities of treasury, we have front office, mid office, and the back office. In the front office, what we do, the trading, and the first initiation of any trade happens at the front office. So for front office, we have dealers. We have fixed income dealers, we have equity dealers, we have forex dealers. So these dealers, they will do the trades, and with that trade, they will make money or they may lose money. So this, whatever trade the front office is doing, is settled by the back office. So back office will settle all these trades on behalf of the dealers, and then they do the settlement of the funds also. Then in between comes the mid office. So mid office, they do risk control. They do a kind of risk management for the front office. They ensure that whatever limits are given to the front office, might be the exposure limit, might be the cut loss limit. So this front office is working within those limits. That is ensured by our mid office. Then comes other functions of the treasuries are the liquidity management. They do the liquidity management for the bank. Miss, how liquid a bank is. After Basel III, there are two important parameters have been introduced for the commercial banks, like liquidity coverage ratio and the net stable funding ratio. So the treasury, the ALM department of the asset liability management department of the treasury, they take care of the liquidity management. Then comes the funding and the capital structure. Treasury also will decide how the funding will be made for the investments as well as for the lending, and what would be the capital structure, how they will manage capital. So that is discussed, that is done in this department. And the cash flow management. Cash flow management also is a very, very important function of the treasury. So because they have to do it is a kind of part of the asset liability management. When a particular fund a bank is expected to receive, and when they are receiving, how that fund should be utilized. So that is being taken care by the treasury. So under the treasury management, we have seen these are the main work a treasury does. Now, how our curriculum is helping us to make us fit for treasury operations, for a treasury. We have particular books in our curriculum. We have particular books for fixed income, equity, derivatives, alternative investments, where we study what are the various instruments available under these segments and how they work. We get in-depth knowledge of these products. So it helps us when we are joining any bank. So I previously also I told, when somebody is joining any commercial bank, initially they may not be able to get these main departments of a bank, but once you have done your CFA, you have done your CFA, that time with the knowledge of these products, you will find yourself very, very comfortable in these departments. Now, investment management. Investment management is nothing but the asset allocation, portfolio management, and various investment studies. So in the curriculum, we understand how the asset allocation helps, what are the various portfolio management strategies, and how investment can be made, where we are getting surplus, how to invest that surplus, and what is the trade-off between the risk and return. So this everything has been covered in detail. So it makes you fit into the investment management. And there are other treasury operations which I have discussed previously also: front office, mid office, and back office. So this way, we for the back office, we need to understand the payment system, what type of payment system we have, what are the settlement processes, how the liquidity management tools are used. So this everything is covered in detail in our curriculum, which helps us in being a good, being properly fit in this treasury management. Then now, risk management. Risk management is also a very, very critical department of any commercial bank. Risk management, we have operational risk, we have credit risk, we have market risk. When we are into the credit, the first department was the credit management department. There we deal with the credit risk management. And the treasury management, we deal with the market risk. What type of market risk one particular instrument will have. So we understand various type of market risk involved in the treasury. Then comes the operational risk. Operational risk can be in any department. Means while functioning in any organization, people, process, and product, these three things, how they can fail and how they can result in a risk to a bank. So this things is covered under operational risk. So broadly, risk management department works on the five main parameters. First is risk identification. We need to identify what risk we are having, and what is and how profitable it would be if we take that risk. So that identification of risk is very important. We need to know, yes, we are taking risk. We are aware of this risk. We know what type of risk is involved in this. So first part is we need to understand what kind of risk will be involved if we are taking any investment activity, we are making any credit decision. So what are the risks involved that we need to understand first. Then comes the risk assessment. We need once we have identified the risk, we need to understand what would be the quantum of that risk. How can we quantify that risk? What would be the volume of that risk? How much it can affect me and my bank and the entire profitability of my bank. So then after that assessment of that risk, again the measurement comes as a part of assessment only, where we will do the quantification of the risk. We have various models through which we do the measurement of this risk. Yes, this much risk we are exposed to. These modeling helps us to predict or to analyze and to have an advanced knowledge that this much of risk we are exposed to. Once we know the risk, once we know the quantum of risk we are exposing, we need to know whether this risk can be mitigated. If it can be mitigated, how it can be mitigated, and how much it can be mitigated, and do we have any control on this risk? This comes under this. So risk mitigation, we study about risk. There is one strategy called avoid, one is transfer, and mitigate. Sometimes we feel this we are not equipped to handle this risk, we will avoid that risk. We will not take that risk. So that is avoidance of risk. Then second thing is, can I transfer this risk? Yes. If I can transfer, if the I pay fee for this transfer, whether that fee is lesser than what profit I'll make, so then I will transfer that risk. Third is other ways of mitigating risk, like putting proper check and balances and putting proper monitoring of the limit. So that is risk mitigation and control. Then once risk mitigation and control come, then we need to regularly monitor whether whatever limits we have fixed, are we within that limit, whether whatever risk we have anticipated, whether we are within that limit or we are crossing that limit. So that comes under this risk monitoring. And with the risk monitoring, there is something called reporting, risk reporting, where we need to report the risk to our higher officials as well as to the regulator. So this was all about risk management. Then we will see how our curriculum is helping us to equip ourselves for the risk management department. In the risk management department, we cover various risk management concepts, principles, and practices. In the commercial bank, if we have this knowledge, if we have the knowledge of this risk management concepts or the principle, it will help us to understand the various concepts which are not common in the other department. If you are in a branch operation, if you are in retail banking, this particular terminology, this particular knowledge will not be available. But our curriculum provides a vast knowledge of these concepts, this risk concept, and the principle, which helps us to be a better manager in risk management department. As I have already discussed, CFA curriculum helps us to understand credit risk, market risk, and the operational risk, and various ways of handling this risk. So in the quant, which is one of the important unit of our CFA curriculum, quant, where we understand various quantitative techniques, statistical analysis, and financial modeling, through which we understand risk, we quantify risk, and then we have various tools which will tell us whether whatever risk measuring tools we have, whether they are working properly, whether they are providing proper assessment. So for that, we do scenario testing, scenario analysis we do stress testing we do. So this quantitative skills helps us proper risk measurement as well as decision making. Then ethical consideration, which is a very, very critical, important part of our CFA curriculum, which helps us to be fit not only in the risk management, any department of our commercial banking, to be a good manager, to be a responsible manager, to be a trustworthy manager. So this CFA, our CFA Institute's ethical learning, ethics and standards of professional conduct helps us to remain ethical in all our dealings. So this is how CFA curriculum is helping us to be good at risk management. Now, one of the emerging departments for the commercial bank, it is the wealth management. Previously, this wealth management was done by some fund houses. They used to do this fund management. Now, commercial banks, various commercial bank, private as well as public sector bank, they have started their wealth management division. In the wealth management, we have to provide wealth solution. We have to provide investment solutions. We have to provide proper planning, financial planning to a client. We will give a financial plan to our client, that by following that plan, how the client would be able to achieve his or her goals. So in that planning, we need some investment tools. We need some investment mechanism. We need to understand how this investment will work, various investment opportunities available, various asset class available. And we also need to understand what is the risk taking capacity of that particular client, how risk averse that client is. So based on that risk assessment, we will select these tools. And then in this wealth management, now the estate planning and the wealth transfer, how a person can transfer good wealth to his coming generation, that also is being planned with the wealth management department. Then we now this wealth management department is working on tax planning and optimization. By using this various tax planning, how we can optimize the return for our clients. Ultimately, client relationship. In the wealth management, the one of the most important thing is how we are maintaining the client relationship. That also is extensively covered in our CFA curriculum. So now in the next part, I will be discussing how our CFA curriculum is helping us to be a very good wealth manager. How to be a good wealth manager, that we will discuss. So if I remember, when I did my CFA level 3, in the CFA level 3, there was a lot of study on this wealth management, and in that, how wealth can be managed, how a particular goal can be set. We study their goal setting. Goal setting means a person need to achieve a goal. We have to have discussion with that client. We have to have a discussion with the client, and in that discussion, we have to find out whether that goal is attainable or not, whether the client has sufficient risk appetite to achieve that goal, whether the client is having a sufficient investment horizon that he can attain that goal, whether the client is having sufficient funds now to invest, in the days to come. So with that analysis, we suggest whether this goal is attainable or not. If not attainable, how that goal can be attainable by changing these parameters. So in that, we do portfolio planning. We plan a portfolio for the client. That portfolio could be having various asset class. Based on the risk appetite of the client, we suggest various asset class, and then we construct a portfolio, and which gives a required return, and based on certain risk involved. So based on the client portfolio, client profile, we decide what type of goal he can achieve and how the goal can be achieved. So that we study. We have curriculum provides a vast coverage of these topics, like private wealth, how a private wealth can be managed, how institutional investing can be managed, how asset allocation can change your asset return, how to change asset allocation so that you can reach your goal, trading, performance evaluation, and finally investment manager selection. So this is vastly covered in our CFA curriculum. So then now comes various other departments in our bank. Banks, some of the commercial bank, they have their insurance division, they have their mutual funds, they have car division, investment banking, and primary dealership. Basically, CFA curriculum gives us broad ideas about various asset class. These asset class are the instrument where these department invest, like insurance. Insurance would be interested. Insurance, various type of insurance, like it would be life insurance, it could be property insurance, it could be health insurance. Based on the type of insurance, based on the liquidity requirement of the insurance company or the product which the insurance company is selling, the the fund manager there will decide which type of investments, which type of instrument, which type of asset class they can put their funds. So same is applicable for the fund manager also, investment banking also, and the primary dealers. For credit card, they give credit. So here also they need to study. They need to study various pattern, various credit scores of a client, and based on that credit score, credit limit is given to a client in the credit card. So these are the other department. There would be some other department which I would have not covered, but basically these are the main department where we feel that our knowledge of the CFA curriculum will help us to be fit there. Yes, this I have covered. So now a quick recap of what I have covered here. First, I will talk about how to get placed without having any big financial course or any big degree, any technical background. If somebody is trying to come into a financial sector, the best thing would be if they can spare some 2-3 months of time and prepare for public sector banks probationary officer exam. They can directly get an entry without paying anything. The first month onward, you will start getting your salary. When someone is doing a management course or going for any higher studies, the person has to invest, and then afterwards the course, 2-3 years course, you have to spend your time for 2-3 years. Then after 2-3 years, then you will come and search a job. But here, if a person who is a graduate, after doing the graduation, if a person can spare, or even while doing graduation, if a person can give some time for the preparation of bank PO exam, with that the person can get an entry into a public sector bank, and along with that, when he or she is in the public sector bank, they can start their CFA curriculum. By the time they acquire a 3 to 4 years of experience, and they would be by the time they would be a CFA charter holder, and with that they will, without investing any amount in any big courses, they will find that they are with the CFA charter, and with the knowledge with the experience of 4 or 5 years in a bank, in a commercial bank, they will be able to get themselves placed where a person coming from big MBA institute. So you will be equivalent to a person who is coming from a big management institute. So just join a bank, continue your CFA program, and by within 4 or 5 years, you will be able to get the salary what other people from the top management institutes are getting. So now a quick wrap up again. We have we have discussed four main departments: credit management department, where we assess the credit risk. What is the credit risk? Miss how that credit risk can be assessed, how that credit risk can be mitigated, how how much exposure we can take, and how we can price that credit risk. That we discuss in the credit management. Then comes the treasury management. Treasury management, bank invest their surplus funds or the fund which they have to invest as per the statutory requirements in India. We the all the commercial banks, they have to invest 18% of their deposit. 18% they have to deposit of their deposits in the SLR in the government, in the form of SLR in the government security they have to invest. And then the risk management, when we take investment, when we do investment, when we do any credit, we need to understand what risk is involved, how much risk is involved, what is our risk appetite, what is our capital base. Based on that, what risk we can take and how we can measure and monitor that risk. Then the wealth management, this is a slightly new department, new area in the commercial banking space, which is also acquiring a lot of prominence now. With the knowledge of with the what we study in our CFA curriculum, with that we are able to give a proper goal setting, proper financial planning to our clients, so that they are able to reach their goals. And then we have various miscellaneous department like uh, mutual funds, life insurance, non-life insurance, credit card. These are the various other departments where also our knowledge of the CFA curriculum helps us to fit well in this. With this, Rajiv, I finished my presentation. I think.
No. Thank you, Mr. Hemant. That was a very insightful presentation that covered all the main verticals from a commercial banking perspective. And more so when you brought in the linkage between what the curriculum brings to the table and what a candidate who is looking at opportunities within various verticals in a bank can go through. So I think that's a very insightful presentation from your side. Before we take up questions, I would just, just to remind the participants that you can continue to post your questions on the Q&A chat that is at the bottom of the screen. So you could continue to post this, even as I take a few questions that have come in from the participants. So just to start with, Hemant, you know, you did mention about the recruitment process that a public sector bank typically undertakes. But is there a way for an experienced professional with specialist qualifications, say like a chartered accountancy and who is specialized in audit, or
Yeah.
someone with a project finance background? How do such professionals look to enter any of these verticals that you mentioned in a public sector bank? How is that process undertaken today?
Okay. Yes. Uh, Basically, in my presentation, I told there are three ways of three entry levels. One is the junior most, one is the middleman, and one is the top executive. So junior one I have complete elaborately covered here. The middle one is a officer in my cadre, Miss Chief Manager or Assistant General Manager cadre. There we see the experience of 10 to 15 years, and if they are charter holder or if they are CFA or CA, so they also get a lateral entry and they are placed directly in that cadre. And they now the structure wise they may be getting around 35 to 40 lakhs based on their expertise and based on what courses they have done. Yes, it is possible.
Okay, so these lateral entrants, do they have to go through the same process of an exam and an interview, or it is purely based on the application that you submit and there's an interview that is conducted? How is
Yes,
that?
yes.
Okay.
For that they don't have to go through the written exam process. It will be a direct one-to-one interaction with the management, and based on that their ability to face that interview, they are selected.
Okay. And how does the recruitment process? You did mention about the process in private sector bank in brief, but if you could just explain a little bit in terms of how some of the private sector banks approach the requirement of filling personnel in specific verticals, say like a treasury or even a wealth management. So, what is the process that a private sector bank follows in India?
Basically, private sector banks, they go for treasury, a department like treasury, they go for the campus interviews.
Okay.
They will be visiting the campus of these management or the engineering colleges, where they directly from there they pick the candidate and give them some initial training at their campuses or some of the institutes. From there, then they take them to their treasury.
Okay. Uh, yeah. So just to again stepping back into the process that is undertaken at public sector banks, you mentioned that the assessment either the through the exam, and then there is a GD and an interview, but this
Yes.
is largely assessing your overall analytical ability, right? But for example, once you go through that process and you are selected, and if, for example, your preference is to pursue a career in treasury management or say wealth management, how does that selection happen? Do you, as a recruited officer, do you have the preference of a department, or the bank allots you the department?
Yes, actually, in all the public sector bank, if some officer is joining, they will be joining as a probationary officer. In
Hmm.
the probationary officer, they have to undergo a 2 years of training.
Okay.
Some give 1 to 2 years of training. After that, these specialized department, they create vacancy internally.
Hmm.
Like someone for the treasury, they will be internal vacancy. For that, they will require some 3 or 4 years of experience in the various departments of the bank. then then internally they will have interview, they will have psychometric analysis, they will they then interview and the written exam. Based on that, they will select you in that particular department.
Okay.
And now in some of the bank, like our bank and other bank, they have their overseas branches also. So there, after 4 or 5 years of experience, because we need dealers, we need officials outside also. So for that also there is a process. In that process, you will be called for the written exam and then interview. Then if you are able to successfully clear, you can get posted outside India also for 2 to 3 years.
Say, for example, you are a CFA charter holder. You get selected during this process, and say you get selected, you apply for the treasury management function, and you are selected in the treasury role. Say, for example, say you are starting off as a fixed income dealer.
Yes.
Now, of course, the CFA program does bring its own skill sets in terms of what you bring to the table, but the requirements or the practical requirements on the job could be a bit, there may be a little bit more of market related understanding and some of the nuances that you need to develop. So is there a training that is conducted, or do you have ongoing training during the course of your tenure that enables you to be, because I mean, banking is not only banking, even asset management, from my experience, I can say, I mean, regulatory changes are coming in thick and fast every other day, and it gets only more and more complex, alongside the fact that the markets continue to become more complicated, much more interlinked. So how does that ongoing training or ongoing refresher programs work in a bank? So do you have your own internal training institutes, or do you send the officers on training programs so that they are updated?
Yes, we have both. We have
Okay.
not only us, all the commercial, public sector bank, commercial bank, they have their own internal trainings, as well as they depute the candidates outside the bank also, so that they are equipped with the recent changes. And CFA knowledge also helps, because when you talked about the fixed income, I can give you
Yeah.
a slightly elaborate way I can talk. In the CFA curriculum, what I studied during my level 3, there we studied various kind of strategies in the fixed income which we can have. So those strategies can work. We can use those strategies, because if we know those strategies, we are able to use them and we can get profitable results, right? So because some strategies means we have both type of, for example, we have both type of use. Mean long term, we are seeing like there are technical term also I can use, steepening. If we are seeing steepening,
Hmm.
so if we are reading the yield curve and if we are seeing some steepening is happening, based on that we can position ourselves. And then steepening is also how it is happening. Is it bull steepening or the bear steepening? Based on that, we take a call, and that helps us in taking a proper trade calls. But internally also, we keep getting trainings from our institute as well as from the outside our bank. Yes.
Okay. Uh, in fact, if there are more questions, please do post on the Q&A box. We've got time for a couple of more questions that Mr. Hemant can take. So there is one question that has come in from one of the participants. The question is more specific to equity research. So how does one initial or start a career in equity research, and what sort of path is it that one needs to take if one were to find or one were to look at a career in equity research. And I believe this probably is more maybe related to uh, opportunities for equity research analysts within the banking
Yes.
industry. Yeah.
Yes, in our bank, in our banks also, we have a equity desk. We have equity department which takes exposure in the equity. So there, for taking, there are two types of investment. One is trading. In the trading is purely a dealer's call, and there are the investment calls. For investment call, where the time horizon is slightly more. For the investment strategy, we have a research team. The research team take cares of that. In our bank, in the bank, how when you are recruited, you go through a process. When you are into a treasury, then this department, if you have inclination and if you have done courses like CFA, you will be the one who would be suited for that department, because for the research part, for the research, equity analysis, you need to understand various aspects of equity. It is not just trading, buying and selling. You need to understand the mathematics and the every economics behind this, so that our curriculum helps. So that will help us to be a best fit in that department. Yes.
Okay. Um, banking, is a very, I would say, highly regulated
Yes.
business, right? And I did mention about the complexities, both from changes in the market, and
Yes.
more so, I would say, incrementally from regulatory changes.
Regulators. Yes.
So now, once you are in the bank, of course, you did mention about the training programs that are more technical in nature, dealing with your day-to-day
Yes.
requirements or job requirements. But as a working professional, how is it that you keep yourself abreast of all these regulatory and maybe even market related changes and dynamics? So CFA program, yes, it sort of helps you in the initial stage of being prepared when you enter this commercial banking industry across these various specialized verticals, as you very rightly, very neatly, and in a very cogent manner presented. But what about this uh, ongoing
Changes.
yeah, how does one do that?
Yes. Yeah. Yeah. Basically, in India, if you see, we have various regulators.
Right.
For banks, we have RBI. Even when we have our insurance subsidiary, we have another regulator. We have SEBI as a regulator because we have our mutual funds also. So now we need to decide which market we are in.
Okay.
Basically, we are mainly in which department I am now, or previously I was there in a primary dealership. There, our regulator is RBI. So I need to go through their website daily. It should be in my daily routine that I should keep that page open. I
Mm.
need to see what is being posted, because RBI, before releasing in the press, it comes on their website. We need to keep saying their circulars, and sometimes what RBI does, if they are going to bring some changes, they will bring some drafts.
Okay.
They will
Okay.
bring some
Understood.
draft guidelines. So
Mm.
that draft guidelines, if you read, miss, what are the changes RBI is proposing, then they may ask your suggestions also. So after reading those draft guidelines, we ourselves can provide solution. If we are not in a position to provide solution, we will understand what RBI is going to do. So when the final directions comes, we will be able to relate and we will be able to digest those guidance, because many a time regulators guidance or their circulars are slightly, for a layman, for a beginner, it is slightly difficult to understand. So once we have gone through the draft guidelines, when we see the final draft, when we see the final circular, it helps us to understand that better and implement on our day-to-day work. But in a banks, this implementation parts taken care by the departments which are at our head office level. So they, in turn, based on the RBI's guidance, they issue internal circular, so which we follow in our bank.
Okay. Okay. Maybe we'll just take the last question. In fact, this I think is from a candidate. So his question is, could you share some effective study strategies when you prepare for the CFA exam? And I
Okay.
think his question is more relevant that, from a
Yes.
perspective of clearing the exam in the first attempt. So what are the tips or suggestions that you can give?
Yes. And for this, I just want to tell one thing. Now I am 48. Now I am 48,
Okay.
and I did my CFA in 2022 when I was 46.
Oh,
Okay.
okay.
So the first thing is, if somebody wants to pursue this program, they need to have a stronger why.
Okay. Why? Okay.
Why?
Why are
Why
you doing
I
that?
why
Mm,
I want to do this CFA. I should
mm,
not do it because X and Y XYZ is doing. Why I myself want to do. If you have that answer, you don't need any study.
mm,
That why should be so strong, so burning. So burning means, if you are sitting somewhere, if you're walking somewhere, sleeping more, it should not let you sleep. It should not let you watch TV. It should not let you watch your mobile. If you are able to find out that why, I'm
right.
sure you are through.
Wow, I think that's a very, very nicely put it, because I do second that as well. Even though, when you did mention, my experience was actually peer pressure driven initially, right? I mean, when I saw everyone around me doing it, but
Yes.
yeah, the fundamental fact truth is, I mean, what you did really mention, that the why has to be really, really strong, and I think that becomes the single biggest motivator for you to excel, and ensure that you clear the very, the program is tough, but
Yes.
yeah, you need to have, and again, I think probably the discipline of giving
Yes.
adequate time, probably. Right. Okay, that was a very very insightful session. Thanks a lot for sharing your experience, rather, because you've got a very diverse experience with the largest bank in India across verticals, and I'm sure the participants in today's webinar have really benefited from the rich insights that you have brought. Uh, thanks a lot once again, Hemant, and thanks everyone for being part of the webinar.